Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Friday, and on Fridays we speak to the man, myth, the legend, Mr. Stephen Dow. How you doing, sir?
Fantastic. And yourself?
I'm doing great, man. Do me a favor, do that marketing spiel because I got an important topic that I want to jump into.
Okay. Well, again, I work happily for Velocity March Capital, but all the topics and subjects discussed on this channel are that of my own. So let's get it cracking.
So what I want to talk about here is something that I have been afraid of for a while, for at least a year now. Something now that the Fed is apparently afraid of as well.
Right.
And they are about to stress test the 34 largest banks in the country. And what they're going to stress test a couple of things. Unemployment spiked to 10%, corporate debt problems. But the one that got me is the commercial real estate falling, dare I say, crashing 40%. Now, when we talk commercial real estate, let's be clear. I'm sure it is office. I'm sure it is retail. It is not only apartments. It is that entire sector. But Stephen, you and I have seen some just wacky lending structures in the commercial market the last couple of years.
Yes.
And I could totally see commercial real estate falling 40%. And I just thought we should talk about that.
Sure. Well, I could see that in certain areas, obviously, depending upon, how the economy affects the area, jobs, things of that nature, transitory population, movement, because a lot of people leaving California, coming to Texas and other places. So you're going to see that affecting certain states and certain areas, over the years. So I could see that with us. I mean, if that does happen, like you said, people were doing, 3-year, 5-7-year, short-term fix that may be balloon, maturing at some point during the next several years, as far as, possible recession, things of that nature. What's going to happen with them? Because rates are going to be much higher. Who knows if they're going to be able to afford that payment, if rents are down, if vacancies are up. So
it's gonna be all kinds of bad. In this, again, I have been looking for a pain point similar to the last one. Most people are out there going residential, residential, residential. I will have you note that the Fed is not stress testing residential. It's 30-year fixed, 70% or whatever is below 3%. That's not going to be where the problem is. It's just not this time. The problem is going to be in commercial, because I have seen things that are shockingly bad. For example, I have seen 12-month paper. They got bridge debt. Interest only bridge debt.
I see it all the time.
That is dumb, stupid. That is if you can only get a commercial deal done with a 1-year bridge debt, you are beyond
not doing the work.
You're not doing the work. Yeah. If your business is built on transactions and getting paid to do the deal because you're borrowing LP's money, you need a new business. That's not okay. Then I've seen, because again, I'm an accredited investor and I get deals almost every day. I've seen unrealistic rent increases. We have seen rent increases, like I talked about today, in Austin and Miami of 30%. Not normal, will not continue, frankly, can't continue. Renters are payment constrained. It's nuts today. I've seen 5% for the next 5 years. That's not okay. That's not going to happen.
Could you imagine? Oh my goodness.
No. And then
homelessness would go up. People couldn't afford it. They're like, my income's staying the same. I mean, that's you saying that your income's going to increase as well over the next several years at 5%. And I don't know if that's going to happen. So we'll see.
And then lastly, I've seen some people assume cap rates are going down from the insane compressed levels today. Not okay. And again, we're seeing the 2-year spike, the 10-year spike. The Fed's going to do this or that. And cap rates, in my opinion, have to go up. So if you get higher cap rates, lower NOI, more vacancies, more evictions, all of these things, that's going to lead to a refi or a reappraisal or whatever you want to call it in a year, 2 or 3, that is going to end up with you cutting a big check or selling the property. It's not going to be good.
No, not for the smaller, investor, mom and pop type investors, because, you're going to have these hedge funds and these other corporations that'll come in, happily snap them up, just like the last, mortgage meltdown. I mean, those are the only people, that really want, because they're just on the sidelines with all this extra cash and waiting for, people in distress and just like, hey, I'll help you out, but I'll pennies on the dollar, pennies on the dollar. So
yeah, people that are out there screaming cash is trash don't understand that cash is an option on the future.
right.
And yeah, it's the most toxic soup I see today is in the commercial real estate market because they're doing bad debt. What was wrong last time? You were getting yes answers on deals that should have been no's.
Right.
Right now, people are getting yes answers because they're getting wacky debt structures at crazy rates. They're getting all this private capital come in as equity.
Sure.
And the GP has very little skin in the game. They're like, oh, sorry, can't send you your yield. And oh, by the way, I got a call for capital because the appraisal came in 30% low. Who's got an extra $1 million for me so we can keep this asset? Yeah.
So we'll see either way. Yeah. I mean, pain, I could see that. And again, it's just so hard to kind of see because we live in a wacky world nowadays with so many things that can affect the economy, geopolitical events, potential war, getting hacked. I mean, there's just, I don't want to be, negative Ned over here, but yeah, it's just, it's wacky times. But as far as what we could see is, affecting commercial finance, yeah, again, for people that were, rate chasing and looking at short-term yield and not doing the work as far as, a couple years down the road, we'll see how this is going to affect them. I mean, hopefully they weren't, kind of calculating too much of an increase in rents and things of nature as far as their cap rates. So we'll see how that works out. But yeah, I mean, either way, for us, we're still doing, pretty well. We're seeing an uptick in just maybe repositioning some assets, I think, as far as long-term.
Yeah, that's why I came to you, right? I came to you. We did deals with an S because you gave me 30-year fixed rate money on apartments and office. That's what I wanted. I did. Dude, I was so terrified about what 2025 might bring that I'm like, dude, I will pay more. And now I look like a genius because I got rates. I got rates under 4%.
For 30 years.
Yeah, for 30-year fixed on in an office. I mean, with cash out, man, craziness. I mean, it's in hindsight, I look like a genius, but yeah, it's we got folks. If you're an LP, I'm really concerned about LPs, limited partners, the equity. Sure. Do yourself a favor, do an extra research on the debt. What is the debt structure in the term? If you have short-term debt, short-term meaning 5 years or less, ask yourself questions, ask really hard questions. And then look at the reserves. I've seen even some deals now that their reserves look almost comical. It's like, did you drop a zero? Where's the extra? Are you
because again, I think human behavior, because in theory it sounds great, but in execution, you got people's lifestyles, you got distractions, you got their personal just hang up baggage, whatever the case may be. It's just not typical. Dion is kind of not common as far as the individual discipline, as far as utilizing the tool. So that's the part that I think in how we discuss certain things in general perspective, it doesn't go well for most people, but it could for certain people like Dion and things of that nature who really know how to apply that extra cash flow and stuff like that. But it'll be interesting either way. We've been around for a long time and in this particular space due to that repositioning and how we underwrite as well and with more skin in the game, it's worked out pretty well. Our default rate is actually lower than Fannie Freddie, so that'll tell you something as far as skin in the game versus verifying income. Yeah,
I've been telling people for a long time, if you're looking at any kind of commercial stuff, you've got to call Stephen Dow from Velocity Mortgage because I mean that 30-year debt fixed for 30 years is at
least having the conversation.
Yeah.
Right. You never know, given your specific scenario and circumstances and what resources you may have, we can try to find out what the best, course of action would be given, right now, your future plans and things of that nature. So yeah, get a hold of me, sdow@velocitymortgage.com. Please leave in the subject line, ORAAT, which stands for one rental at a time. Sometimes people make the mistake of leaving out the A and they get stuck in quarantine.
There's 2 A's.
So sorry for the 2 A's. The body of the email, maybe a brief description of what you're looking for, and a telephone number where I can reach you back at and make a quick phone call versus back and forth emails. And yeah, I'd love to kind of have a conversation. I normally work on weekends. this weekend's going to be Super Bowl weekend, so I might be
Take
off on Sunday.
You can take Sunday off. Only Saturday.
Okay, you got it. Thanks, Mike. Appreciate it.
I appreciate it. All right,
Yes,
buddy.
sir.
I appreciate you. Thank you for everything. And do you want to make a pick, Rams or Cincy?
Oh man, I gotta go. Well, I gotta be loyal to AFC because you know, my team's in the AFC, so I'm thinking Bengals. Plus the fact that Joe Burrow and T. Higgins were on my fantasy league this year and helped me win it. So
there you go.
Yeah, I gotta go Bengals. Yeah.
There you go. Very cool, man.
Yes,
Good
sir.
luck.
Thanks. You too, buddy.